Bismillahirrahmanirrahim. Assalamu alaikum. This is Salah Reb, your accounting teacher. Today, we are going to discuss a new topic of bank reconciliation statement. Before we start this topic, I would request you to please subscribe my channel and press the bell icon so that you will be able to receive the videos in future as well. All right, G. So today we are going to talk about the bank reconciliation statement, what bank reconciliation statement is. Guys, a bank reconciliation statement is prepared by a business to find out the difference between the bank balance of cash book and the balance appearing in the bank statement provided by the bank. Before we move on to the topic, let me give you a little description about this particular transaction. As you already know, that the business records all the cash transactions and the bank transaction in cash book, which means that all the cash received and paid and all the amount received in bank and payment through bank by the business are recorded in the cash book. Later on, the cash book is balanced to calculate the balance brought down for the next month. It shows how much amount the business has received and how much amount a business has paid and what is the balance at the end of the month. Now, later on, the business tallies the amount with its cash, which is available in the office, and it also tallies the balance of bank with the bank statement provided by the bank. A bank statement is basically a statement which has a debit, credit, and a balance column. It is provided by the bank, which shows all the transactions of cash deposit of amount deposited in the bank by the business and the amount withdrawn by the business from the bank, and what is the balance according to the bank. Now, later on, the business tallies the bank balance and the bank statement balance. And most of the time, remember, the balance of cash book, the bank balance in the cash book, and the balance shown in the bank statement differs. There are certain reasons. And what are those reasons? Number one, the different time at which the same amounts are recorded. For example, when the business has received the check, it has already recorded it into the cash book on the same day. But when the check was deposited in the bank, it took 2 days to clear or to be recorded in by the bank. So the 2 days difference can also be seen there. On the other hand, for example, the business has paid to someone. So when the business is paying by check, the business is recording on the spot in the cash book. So according to business, the payment has already been made, but it will take 2 days, or maybe the person has not yet presented that check in the business into the bank account for more than 2 days. So the difference can be there, that in the bank, that amount will not be shown, but in the business, that amount has already been credited. The other reason is the business not recording certain items in the cash book. It can also be possible that the owner has deposited or withdrawn the amount online, and the accountant has not been informed. So that recording has not been in the cash book, but it is already there in the bank statement. So these are basically the differences due to which our bank statement provided by the bank and the balance of cash book may differ. Whenever this happens, we need to do two different things. The first is we need to update our cash book, and then we need to prepare a bank reconciliation statement to get to know why the balance is different from the bank cash book. Let's talk about the first step. It means when we prepare the adjusted cash book. See, first the business prepares the cash book. Later on, it tallies it with the bank statement, and then it also updates its cash book. This is the first step. Now, when we are talking about the first step, what are we supposed to do? Here, I am going to tell you, when you adjust or when you amend or when you update your cash book, there are certain items you see while tallying the cash book with the bank statement, you would find some differences, some amounts. And those are those amounts which were in the bank statement, but they were not in the cash book. Those transactions which you could see in your bank statement, maybe on the debit side or maybe on the credit side, but these transactions are not in the cash book at all. So what you will have to do, you will have to update your cash book by adding those transactions maybe on the debit side or on the credit side. Let me tell you one more thing quite interesting, that a cash book prepared by the business and the bank statement may have differences. What difference it may have? A cash book is basically the mirror image of bank statement. A cash book is a mirror image of a bank statement. In other words, the transaction of the business is a mirror image of the transaction by the bank, in the bank. That means to say, whenever we perform a transaction in which the cash book is debited, in bank statement, it is shown on the credit side. Why? Because, for example, when we are depositing our cash into the bank, so according to cash book, our bank has increased. So it must be recorded on the debit side. So we have recorded it on the debit side. But according to bank, it has increased its liability. The amount has to be returned by the bank to you when you demand. So according to bank, it is its liabilities. So when the liability increases, they record it on the credit side. Whereas according to business, the assets have increased. So they are recording it on the debit side. On the other hand, if the business is paying to someone, it decreases its assets. So therefore, they record it on the credit side. But according to bank, the liability has got decreased. So this is why it records it on the debit side. So remember, the debit side of cash book is the credit side of bank statement. The credit side of cash book is actually the debit side of bank statement. This is called mirror image. This shows a mirror image. I hope you have understood this. Now, so moving back to the topic, that first of all, we need to prepare the adjusted cash book. And we need to find out that there are certain transactions which are shown on the debit side of cash book. Now, I'm going to show it like this. There are certain transactions which are shown on the debit side of bank statement, but those transactions are not there on the credit side of cash book. In the same manner, there would be some transactions on the credit side of bank statement, but these transactions are not shown on the debit side of cash book. It means that these transactions have been made directly through the bank, and the accountant has not been informed. Therefore, it has not been recorded in the cash book. So quickly, an accountant has to update its cash book by adding all those transactions which are in the bank statement and not in the cash book. And what are those? The first is direct debit. These are basically all those transactions which are shown in the bank statement, but they are not in the cash book. The first is direct debit. Now, this transaction is according to the bank. Now, the bank says the amount has been directly debited. Now, when the bank says directly debited, it means according to business, it has to be credited, right? So what direct debit is? Direct debits are all the bank charges which the bank deducts. So it's written here, bank deducts certain amount directly from the business account. For example, bank charges or bank interest. These things or these amounts are deducted by the bank directly and the business is not informed. Therefore, the business has not recorded it. So it has to record on the credit side of the cash book with the name of bank charges or maybe direct debit. Now, this direct debit can also be known as DD. In the paper, they may ask you to explain what DD is. DD stands for direct debit, which means the bank charges and bank interest. The second transaction, which can be shown in the bank statement but not in the cash book, is standing order. This is basically the abbreviation. Standing order can be abbreviated as SO. So in the question, if they ask you to explain what SO is, it means it is actually in standing order. And what standing order is? In writing, instructions have been given, or when the instructions are given to the bank to pay on business behalf a certain amount directly from the bank account of the business. For example, here the business has not given any check to anyone, but directly instructed the bank that at the end of every month, a certain amount can be deducted from the account and can be paid to someone. For example, if the business is paying monthly rent, so rather than giving the checks, a business can give in writing an instruction to its bank that an amount of, let's say, $2,000 can be given to Mr. ABC on behalf of him as a rent of that particular place which the business is being used, which the business is using. So what will happen? At the end of the month, the bank directly deduct the amount and will pay the amount to that person. Now, as the checks have not been used, so this amount will not be shown in the cash book. Therefore, the business has to record this standing order on the credit side of cash book. The question is, sir, why the credit side? The reason is that the standing order is an amount which is paid by the bank to someone. It means the business is paying. So it will be shown on the debit side of the bank statement. So you will have to record this on the credit side of your cash book. The third is credit transfer or direct credit. It can also be abbreviated as DC or CT. Mostly, they will ask you CT. They will give you the abbreviation of CT. That means credit transfer. But it can also be known as direct credit. What direct credit is? Beta, according to business, according to bank, credit means your debit. The bank has credited the amount. It means in your account, according to you, the amount has been debited. Somebody has deposited that account. Now see what it says. A customer deposits directly in the business bank account, or a refund is received directly by a creditor due to overpayment. It can be possible that you have paid to someone, you have overpaid to someone, and the creditor has refund that amount to you, and that amount has directly been deposited in your bank account, but you will never know because the check was not received. So you have not recorded it in the cash book, but in the bank statement on the credit side, it is already there. It can also be like this. For example, that if a commission has been received, that commission is directly deposited into your bank account and you have not been informed. So you have to record it in your cash book when you see that this amount is recorded on the credit side of bank statement. Finally, we have dishonored check. A dishonored check is a check which has been returned by the bank because it may have insufficient fund, or maybe there was an error in the check. Remember, dishonored check is basically returned by the business. Why? because it may have insufficient fund, or it may have error in the check. In your question, they may ask you. So due to this, the check is returned. It is not accepted by the bank. So now, remember, when you have deposited, maybe last month, you deposited a check of Mr. A in your bank account. So it is already shown in your cash book. But now, after 2 or 3 days, or maybe after 4 days, when the month got changed, you got the information that the check has been dishonored. It has not been accepted. So what you will have to do, you will have to record this dishonored check on the credit side of cash book. I hope this is clear to you. All right, so as we were talking about the updated cash book, that the first thing a business does is to update the cash book. To update the cash book, the business has to see the transactions which are in the bank statement, not in the cash book. And all those transactions are to be updated in the cash book. Now, how are they going to update this? We have a format for you here. This is the format. You could see that this is the format of updated cash book. Now, this is the T account. I have just made a T account like this. This is a T account. On the left-hand side is the debit side. On the right-hand side is the credit side. Now, on the left-hand side, the balance brought down shows the balance of old cash book. This is basically the balance of old cash book. But if the balance is on the credit side, it means bank overdraft. You already know what bank overdraft is. Let me tell you that if the bank balance is on debit side, it means the amount is available. But if it is on the credit side, it means that the amount is insufficient and the business has taken the amount from the bank more than the amount available. So the bank account went into minus, into negative. That can be called actually bank overdraft. So, like I said, the format of updated cash book is, first you will have to write the balance brought down of the old cash book. Sometimes the examiner will give you the balance of old cash book. Sometimes you will have to calculate it. So if the balance is on the debit side, this is the normal balance. But if the balance brought down of the old cash book is on the credit side, it means bank overdraft. Now, all those transactions which are on the credit side of the bank statement should be on the debit side of updated cash book. What are those? The first is direct credit. You already know direct credit means the amount has directly been deposited in the bank. So according to you, the bank should be increased. Therefore, you have increased the bank. So bank has been debited against credit transfer. They may also give you interest credited. Maybe you have received interest by the bank and the bank has directly deposited it into your account. So this will increase your bank. The next is dividend. Maybe you have taken out, or you may have taken the shares of a limited company and they have given you the dividends. The dividends have directly been deposited into your bank account. So on the credit side of bank statement, it will be shown. You have to record it on the debit side of it. Now, once you are done with the debit side, move on to the credit side. In your bank statement, these transactions will be shown on the debit side, and you have to record it on the credit side. On the debit side of bank statement, it will be shown bank charges deducted by the bank. You have to deduct it from your bank. So it will come on the credit side. Then standing order, the amount has been deducted from the bank. It will be shown on the debit side and you have to deduct it from your bank account. Interest charged by the business, by the bank from the business. This amount will be deducted from the cash book. A dishonored check will also be shown on the credit side of it. Now you take the balance. After taking the balance brought down can be on the debit side or it can be on the credit side. I will not go in the detail of T account. It has already been discussed in my previous lecture. So after calculating the updated cash book, now you have a new balance brought down of updated cash book, maybe on debit side, or it could also be on the credit side. Once again, if the updated cash book balance is on debit side, it's a normal balance. But if it is on the credit side, again, it's an overdraft. I hope this is clear to you till here. All right. So as we were discussing about bank reconciliation statement, we have already discussed step 1, which says to update the cash book. We have already updated the cash book. And how did we update it? That when all those transactions which were in the bank statement but not in the cash book, we updated it by recording those transactions in our cash book and took out a new balance, which is a balance of updated cash book. Now, after that, we have to go on with step 2. In step 2, the business will have to make a statement which is called bank reconciliation statement. How are they going to do it? Now see, previously when they were updating the cash book, they saw, or the business found out, that the transactions were in the bank statement, but they were not in the cash book. Now it will be vice versa. In step 2, they will see that there are certain transactions which are in the cash book, but this time they are not in the bank statement. It means to say that the transactions have been recorded by the business in the cash book, but due to time difference, those transactions are not shown in the bank statement. Due to time difference, those transactions are not shown in the bank statement. When a business identifies it that these transactions are in the cash book but not in the bank statement, the business has to prepare the bank reconciliation statement. So those transactions which are in the cash book, not in the bank statement, should be the part of your bank reconciliation statement. And there are 2 types of transaction. The first is unpresented checks and uncredited checks. What does unpresented check mean? Unpresented checks means that these checks have been issued by the business to someone. For example, if I'm running a business, I have paid to someone. When I was paying the check, I had already recorded that transaction on the credit side of my cash book. Credit side of the cash book. But it is not shown in the bank statement. Why? Because the person whom I have given the check has not yet presented it in the bank, or they may not have taken the amount from the bank against those checks. So according to business, the amount has already been paid. So it is there on the credit side. But according to bank statement, the amount is not there on the debit side of it. These are called unpresented checks. So unpresented checks are the checks which have been issued by the business and have recorded it on the credit side of the cash book, but the person to whom the check has been paid has not yet presented the check into its bank. Therefore, the bank is unaware about that check and no amount is shown in the bank statement. This is called unpresented checks. The second is uncredited check. Uncredited checks are those checks which are received by the business from someone, maybe the customer. The customer has paid the check to the business has received. Now, after receiving it, the business has recorded on the debit side of the cash book. The uncredited checks have already been recorded on the debit side of the cash book. But what happened? The fund has not been received by my bank from the other bank. Therefore, the amount has not been written in the bank statement. The question arises here, sir, how is it possible? See, what happens here that when you receive a check, you deposit it into your bank account. Your bank asks the other bank to send the fund against the check which the person has given. So the second bank will transfer the fund, the amount to my bank, and then my bank will transfer this amount to my bank account. This takes a little bit time, maybe 2 days or 3 days. So what had happened this time that I received a check and I recorded it on the debit side of it, but my bank had asked for it and the fund has not been received from the second bank. From my customer's bank, the fund has not been received. So this amount is not shown on the bank statement of my business or my account, right? So that is called uncredited checks. I repeat, unpresented checks are given the checks which are paid by the business, but it has not been presented. And uncredited checks are those checks which the business has received, but the fund has not been received by my bank. So this amount is not shown. Now again, remember, when it comes to this particular bank reconciliation statement, it has two different formats. In exams, they may ask you to prepare the bank reconciliation statement of format 1 or maybe format 2. How are we going to make format 1 and format 2? If they ask you to prepare the bank reconciliation statement and find out the balance of bank statement, they are asking you format 1. If they ask you that they have the balance of bank statement and they ask you to find out the balance of updated cash book, then you will have to use format 2. Both are same. It's not a big deal. It's an inverse operation if you have already studied it in your mathematics. Now, let's discuss about format 1. In format 1, first of all, the first thing is you will have to use the balance of updated cash book which you have already calculated in step 1. Then you will have to add unpresented checks. These unpresented checks are already shown on the credit side of your cash book. You have to add it. So the balance of updated cash book will be added with unpresented checks to get the total. This total will be subtracted with uncredited checks to get to know the balance of bank statement. So this is actually the format that the balance of updated cash book is added with unpresented checks. The total is subtracted with uncredited checks to get to know the total of or the balance of bank statement. And this balance actually matches the bank statement or the amount shown in the question. If they ask you for the format 2, they will give you the question or they will give you the balance of bank statement and you will have to calculate the balance of updated cash book. So this time the format 1 will be in inverse operation. It will be done in inverse operation. For example, when they ask you in format 1, unpresented checks are added, but now unpresented checks will be subtracted with the bank statement, right? So the balance of bank statement will be subtracted with unpresented checks to get to know the total. This total will be added with uncredited checks where you will get the balance of updated cash book. And this balance should match the balance of your updated cash book which you had already made in step 1. If this matches, it means that your answer has clearly been made. You have already done your answer and it is clear and perfect. I hope this is clear to you. Last but not least, we have advantages of bank reconciliation statement. In examination, they will ask you, what are the advantages of bank reconciliation statement? Number 4, the first advantage is after updating the bank account, an accurate bank balance is available. Next, errors in the bank account or on the bank statement can be identified. We can easily identify what are the errors of the bank account or what are the errors in the bank statement. The third advantage of bank reconciliation statement is it helps in discovering fraud and confusion, embezzlement. The fourth is amounts not credited by the bank can easily be identified. So this is how we prepare the bank reconciliation statement. I hope this is clear to you. If you have understood this or if you have liked this video, please share it with others so that others can also find it fruitful. Thank you. Take care. Allah Hafiz.